Headlines, headlines, headlines. Everyone is talking about how the real estate market is cooling off or about to crash. And it's time someone talks about the other side of that story. The story that says it's going to last longer and stronger than you think. That's what I'm talking about today. It's J-Dub, MrDowntownDelray with EXP Realty here in Delray Beach, Florida. And if this is your first time to my channel and you want to learn everything about what to do here, how to chill here, maybe just live here, go ahead, subscribe to my channel, hit that bell so you're notified every time a new video drops. And here's the thing, folks like you are calling me weekly, wanting to know everything about this place. If that's you, text me, call me, drop me an email. Yeah.
Call me.
Call me. Today, everyone is saying, is the market cooling off? Is it going to crash? Maybe. I don't know, but there's another side of that story I want to talk about, and we're going to talk about that right now. Before we dive into today's chart, graph, headline heavy analysis of the real estate market, I want to remind you, please stick around toward the end where I give you my top 6 fundamental metrics I've been using for years. If you pay attention to these metrics, you'll be able to use them to understand where the market's going and steer clear from these crazy headlines. Speaking of which, I worked for a handful of years for the financial publishing industry. I learned a lot about what triggers people, and there's 2 things, fear or greed. And it's important to separate those, put those aside when you're looking at headlines, because what they're trying to do is grab your attention. They're there to sell material and information. So let me talk a little bit how that works. In the publishing industry for real estate, right now the best-selling article is about fear. Think about it. Prices keep going up, up, up. Inventory keeps going down, down, down. Lumber prices went through the roof. All these things about why this is just going to be like 2008 and there's going to be a crash and that the boom is over. But they've got you. You see, every time you click on one of these articles, they know exactly what you want to hear. So they produce more of it. Let's take a look. So let's think about this. What type of emotion does it spark when you read these? Here we go. Existing home sales rise 1.4%, lower than 2.2% forecast. Who cares? What does someone forecast and why does that have anything to do with what's going to happen to the marketplace? How risky is the booming housing market? Risky? Well, I don't know. Buy a house. Housing boom comes to an end. Well, as far as I know, there's no end to this thing, and hasn't come to an end as far as I'm aware of. Buyers and sellers are everywhere. Fewer contract signings could signal market turn. Fewer market contract signings? Okay. A housing market crash is coming. Here's how to prepare. Really? There's a housing market crash coming? Who's paying attention to this? There's a lot of fundamentals we're going to talk about. The housing boom is officially over. Home sales dropped to new low. Whoop-de-doo. Volatile interest rates cause mortgage demand to drop. In a few minutes, I'll show you how unvolatile mortgage rates are. And something big is about to happen in the housing market. Woohoo! Can't wait to see that. And finally, the end of the housing boom will be when mortgage rates rise in 2022. Tell me, who has a crystal ball to know when exactly rates are going to rise? So now we understand that the publishing industry is trying to learn what is your hot button, and they got you. Right now it's fear. But once we strip all that stuff away, there's 2 things left, supply and demand. They're the basic fundamentals of real estate and economics. And to better understand what supply and demand looks like, take a look at this. So to learn all about supply and demand, look at this June report for all of Palm Beach County for an example. Single family homes, the first line is closed sales. This is all about demand. It's up 43% from 1,500 to 2,100 sales this year compared to last year. And then down below in inventory is down 36% from 5,000 units down to just over 3,000 units. So basically what it's saying is supply and demand is there's a ton more demand and there's a lot less supply. And until that shifts, there's probably not going to be much change in this industry, in this marketplace. Right now, it is as strong as it can get. Let's take the supply question to another level. Take a look at this chart. I love it. Right now, in the last decade, about 6.5 million units hit the market. But compared to the last 40 years, back to 1970, you're looking up there, 10 million, 12 million units per decade? So we're right now about 40 or 50% less production on new homes. I can't imagine that they're going to be able to go from 6 million to 10 million units overnight. That will then flood the market with more supply, which will put pricing pressure down and create more demand for people to buy more units. It's not going to be overnight. It's going to take years for the inventory to increase, for any significant change in pricing to take place. The next big fundamental piece are interest rates. It's that one headline said how volatile interest rates are. Well, I don't know about that. Here's a chart on interest rates, 30-year fixed mortgages for the last 5 years. They were at 3.5% and rose over 2 years to almost 5%. But starting in late December 2018, they've gone crashing down and now are under 3%. But they're talking about the volatility of interest rates today. Well, basically in the last 6 months, from December of 2020 to today, they've gone from around 2.7 up to 3 and now back to 2.7. That's not what I call volatility. That's what I call stability in the marketplace. The other critical fundamental to take a look at are credit scores across the country. Back in 2005, on the left side of the chart, it was about 688 was the average score. Today, 15 years later, it's 711. And then if you take this next chart, take a look at this. Back during the Great Recession, the big fear was all these low credit score people were getting mortgages. Well, back then, over $376 billion of people with mortgages less than, credit score less than 620 were getting mortgages. Today, that number has dropped to 74 billion. That's a dramatic drop. So credit scores have gone up, mortgage lending has gotten tighter, and they want to make sure your credit is high in order for you to get money. Now, the one chart that gets me a little bit nervous about what's happening is the affordability index. Basically, the higher the number, the more affordable properties are. The lower the number, the more expensive it is. In this chart, if you go back to 2017, the number was at around 170. Then early this year, it got into the low 180s, and now today you can see it's about 152. And this particular chart here goes back just 1 year. So a year ago, you can see it was about 174, 75, and it raced up to January of this year to about 186, and from there it has fallen like a rock today to 151. This does make me a little bit concerned. That means that prices have gotten overheated, means buyers might not be buying at this extreme that we did about 6 months ago, and it certainly has an impact that we need to look at. So the affordability index is a key piece of fundamental data we need to watch moving forward. So based on all the data we just saw, let's summarize where the market is today. Prices. Prices, as we've seen in some markets, have gone up 15, 20, even 28% year over year over the last year. Prices may continue to go up, but they may not go up as much as they have in the past. Next is inventory. Inventory is at all-time lows, and it might take 2, 3, 5, 7 years for this inventory to fluctuate and come back. Keep in mind, builders need to make profit. They're not going to make profit when lumber and material prices are through the roof. So if you think that prices are going to crash or things are going to change overnight, it might take longer than you think.
Longer than that, I think.
Then there's demand. Yeah, we got lots of demand. There's still baby boomers out there, and now there's millennials, and these millennials are getting into their peak earning years, and they want to have families and babies and places to move, so they're moving up from rentals and apartments into homes. So if you think that demand is going to slow anytime soon, it might take a lot longer than you think for things to change.
It's been a lot longer than that.
And then there's interest rates. Interest rates, they're at historic lows. That's why people are buying homes, because money is cheap. And what makes money cheap? Uncertainty. And right now there's what? The government has never printed so much money. We're over $30 trillion in debt in the United States. That's causing a lot of uncertainty. Next is COVID. We've had a year and a half of COVID. Now we have the Delta variant, and that's going crazy right now. That's uncertain. That's going to keep rates low. Just look what's happened in the last 30 days. And then there might be the Alpha variant, and the Beta variant, and all these other variants that might come on board. So if you think that rates are going to go spiking anytime soon, I don't know. You got to take a look at things the way they are today. And it might take a lot longer than you think for interest rates to rise, where it's going to make a difference in the marketplace. So with all that information, here are 6 things you should be doing right now to take a look at the real estate market. Number 1, focus on fundamentals. I gave you lots of graphs and data points for you to focus on. Focus on that and that alone.
Let's concentrate on the fundamentals.
Number 2, don't click on articles from publishing companies about fear. That's what they're to do. They're here to spark your emotion. The more you click on these fear headlines, the more they write about it. And the more they write about it, the more fear they create. Stop.
No fear.
Number 3, keep a close eye on all the charts I provided above. Look at them quarterly, or you know what, monthly is fine too, but don't look at the daily gyrations. Don't get involved in that. It doesn't mean a lot. You're not going to gain much from that information. And if you need to get access to those charts and data points, call me. Send me a text. I'd be happy to share information with you.
Call me.
Number 4, watch the inventory level. That's a real critical factor. I showed you 6.5 million units over the last decade versus about 10 to 12 million units. That's a lot of inventory that has to be produced. And you know what? It's going to take a lot longer than you think for them to build more homes out there. So take a look at inventory levels on a quarterly basis.
Show me your inventory.
Number 5, watch mortgage rates. They're very low, historic lows. They're below 3. They're probably going to hover around 3, maybe stay under 3.5 for a lot longer than you think. I'd take a look at that. Watch what's happening with the government and the government spending and the fear and COVID. As long as those things are here, rates will stay low. But keep an eye on rates meticulously. And number 6, for gosh sakes, pay attention to how much money our government is printing. They've been printing trillions of dollars for years now. That puts a lot of pressure and uncertainty in the markets. And while they print more and more money, look what's happened to interest rates. They keep going down, down, down. So would the opposite be true? If they stop printing money and stop buying bonds in the marketplace, would that mean rates go up and it would soften the market? Perhaps. It's one of the biggest things and one of the biggest pieces of fundamentals you should keep your eye on today. That was a lot of information. I hope you got a lot of value out of today's video. Remember, if you have not subscribed to my channel, please do so. Subscribe, hit that button so you're notified every time a new video is dropped. I wish you good investment decisions, and if you need any data from me, by all means, call me, text me, send me an email. I'm waiting, and I'll see you next time.